What's up, everybody? Earnings season is back. Elevance is the first major health insurance company to release their Q3 earnings, so we're going to take a look at that today. UNH is releasing their earnings in a week. We'll take a look at that then, of course, as well. Now, I'm sure it's no surprise to anyone who's been following the channel that I'm quite bullish on healthcare. I made a video after the Q2 earnings of all these companies saying healthcare is cheap and I am buying. That was the end of July. At the time, Elevance was about $280 a share. UNH was about $280 a share. Centene was about $27 a share. So pretty much whichever of these companies that you were buying, I own all three of the ones I just named. You're up quite a bit from that point, 25-ish% in Elevance. UNH, you're up maybe 30 to 40%, depending on how close to that low you really got. So we've had a nice bounce here, but the question is, now that the stock is higher, should we take profits? Does risk reward still look good? What should we be doing today? So we're going to answer all those questions. I'll tell you what I'm doing with my money. As always, if you get value out of the video, subscribe to the channel. If you want to make spreadsheets like this, or you just want to support the work that I do, then consider checking out my Patreon. Now let's get into Elevance. If this is your first video here, or you just want a refresher, the reason why basically all these major health insurance companies are down over the past year is because health costs have come in significantly above where they were expecting, and in a business of single-digit margins. I mean, Elevance, for example, has historically had 5-6% operating margins, and they're basically maybe the second most profitable company in terms of operating margin, right after UNH. So when you have a company with such thin margins, when you underestimate costs even by a bit, costs just come in a few percent higher than you thought, that can completely crush the bottom line. And if I were to just give the one-liner pitch for Elevance, UNH, all these companies, it's managed healthcare isn't going anywhere in the United States. These companies are going to reprice their plans. Margins are going to normalize. Demand for healthcare certainly is going nowhere. So revenue growth will be there for all of these companies. And if you believe that, then they're just too cheap, and they certainly were way too cheap, under $300 a share for Elevance, in my opinion. Now, jumping into these third quarter earnings, we see operating revenue growth very strong, 12% year over year. Now, this is not all organic revenue growth. They've made some acquisitions, most notably CareBridge. CareBridge is part of their health services segment, and it was not part of their Q3 2024 numbers. They finalized that acquisition at the end of 2024. But even without CareBridge, revenue growth year over year would be high single digits, so that's quite strong. The problem is margins, costs, profitability here. We see benefit expense ratio. This is a measure of what percent of premiums do they have to pay out for health care. And this number, 91.3%, this is pretty much in line with what they were guiding for the past quarter, but this is quite high. And yeah, you see that's only 2% higher than the quarter last year at 89.5%. So, it seems like they didn't underestimate costs by too much. But as I said, this has an enormous effect on the bottom line. Operating gain, operating margin, pretty much cut in half from where it was a year ago. The way health insurance works, you reprice your plans in cycles. A lot of their plans, whether it's Medicaid or, marketplace plans, they're repriced on January 1st. Some Medicaid plans are repriced on July 1st. Every state runs Medicaid a little bit differently. But the point is, you can't significantly increase your premiums, increase your profitability in the middle of a cycle. So guess what? Q4 of this year, it's going to be weak as well. Now, breaking the business down by segment, the majority of Elevance is their health benefits side of the business. This is the health insurance arm. As we see, operating gain reduction of 63% year over year. Whether we're talking about Medicare, Medicaid, individual marketplace, pretty much costs were up significantly across the board. They were buffered a little bit by their health services side of their business. This is Carelon and Carelon RX, which is their pharmacy benefits manager. Operating revenue is up a ton, more than 30% year over year because of their acquisition of CareBridge. Even without that, though, this segment would be up double digits. Health services has been growing faster than the company as a whole. And while margins took a hit, it wasn't quite as ugly as the insurance wing. In fact, if you just look at the numbers for this quarter, it was a significant beat from where they were guiding. Revenue over $50 billion, adjusted EPS of over $6, even GAAP EPS, which was about $5 a share. I mean, they were beating on all estimates. They gave some really ugly guidance last quarter in their Q2 call, and I think they just wanted to put out numbers that they knew that they could beat, and they certainly did. But so much of the focus and what's more important than the numbers for this specific quarter is just what are long-term margins going to look like? What's it going to look like for next year, for 2027? On the call, 2026 was mentioned 39 times, I see. They did not give any specific guidance for next year, but they did talk about 2026 a bit, and it certainly felt like every analyst question was about the future, was about 2026, profitability, where they see margins. As far as what they said, in Medicare Advantage, we've taken disciplined action to improve profitability in 2026. We're focusing on retention and value while exiting plans not aligned with our long-term strategy. Basically, we're not looking for growth at any cost. We're okay if we lose some membership in some areas because we are focusing on profitable plans. And indeed, they did say on the call that membership may decline a little bit next year. They say for the 2027 payment year, approximately 55% of our Medicare Advantage members will be in 4-star or higher contracts. That's up quite a bit from the payment year 2026. So Medicare Advantage going to be becoming more profitable for Elevance. Margins should be increasing there. Now, in case you're wondering, what in the world is payment year 2027, payment year 2026? How do they know these numbers right now? Well, payment year 2027, that's payments that the plans will actually receive in 2027. But they're based on star ratings, which are essentially a measure of quality of the care that the plan provides that are released the previous year. So 2027 payment year based on star ratings that come out October 2026. And those 2026 star ratings are themselves based on quality and performance data that is from 2025. So they actually have pretty accurate prediction of the 2027 payment year right now in 2025. I know that seems a little bit weird and confusing, especially I'm sure to people who don't live in the US and probably have a very different healthcare system. On the health services side, their pharmacy benefits manager, Carelon, external revenue grew double digits year over year. Carelon RX had another strong selling season for 2026. So I expect growth in the Carelon segment to remain fairly strong next year in 2026. One piece of, maybe you could call it guidance, they're not calling it guidance, but certainly expectations that you could expect for next year that I think underperformed was Medicaid. In Medicaid, re-verification effects have raised acuity and sustained higher cost trends, and states are preparing program changes that will influence the pace of rate adequacy. This is a post-COVID effect, which honestly is driving a lot of the cost trends that we're seeing in healthcare. But basically, in COVID, you were not allowed to kick people off of Medicaid. So Medicaid enrollment really ballooned until basically 2023, when you could go through re-verifications, which is basically checking, hey, are you really eligible for Medicaid? Medicaid, in case you're not familiar with it, this is primarily for lower income people. There are eligibility requirements, and once you had to go through re-verification, check, hey, are you really still eligible for Medicaid? Then numbers started to normalize. They've dropped. They're continuing to drop slightly, though not as much, but really the effect here is that the people who are dropping out of Medicaid are disproportionately healthy people. So the people being left in the population have higher acuity, meaning they're sicker. They cost more to provide healthcare for. So Elevance is saying, hey, because of this, because of these re-verification effects, we have higher acuity and sustained higher cost trends. They're expecting this to bottom out in 2026, but 2026 is not going to be a great year for Medicaid. That is what Elevance is saying. Now, we already knew this. They talked about it a bit on the last call, and even recently, there was some day in early September where the CFO of Elevance was talking about Medicaid and basically said, hey, cost trend is going to be high. And Elevance dropped like 4% that day. Centene as well, which is very exposed to Medicaid, also dropped significantly that day. So the margin recovery story for Elevance, I think overall, 2026 is going to be better than 2025. However, that might not be the case specifically for Medicaid. The full recovery is going to take time. It's going to take a couple rate reprice cycles. As far as the long-term expectations from management, they continue to say that revenue growth is going to be high single digits and operating margins, they're going to normalize, expanding to 6.5% to 7%, targeting at least 12% annual growth in EPS. This is basically what the company has been saying, and it's pretty much, again, the core of my thesis, which is, yeah, we're going to have a couple bad years here, but the long-term story has not changed. Revenue for Elevance 5 years from now, 10 years from now, it's going to be quite a bit higher than today, and margins are going to recover. The massive drop-off in price we've seen in the stock is an overreaction. And clearly that's what the company thinks too, because in the meantime, they have been buying back a significant number of shares. During the quarter, the company repurchased about 3 million shares for an average price of roughly $300 a share. This company has been doing buybacks, but this is way more than normal. They were taking advantage of their cheap stock, and as a shareholder, I like to see that. The CEO of the company, Gail Boudreaux, also bought about $2.5 million of stock down here too. So I think it's time to go to our spreadsheet and decide what we think we can get for a return on our investment for Elevance stock today. For my base case, I'm giving them 7% revenue growth on the top line. I think that's completely reasonable. Operating margins, I'm assuming they recover to 6%. This, I think, is pretty reasonable compared with where operating margins have been for this company. They're guiding for long-run adjusted operating margins of 6.5% to 7%. Now, they have some adjustments in there that are boosting those numbers a little bit, but I think 6% operating margin is fair. We're getting some money coming back to us shareholders in the form of dividends and buybacks, and after 5 years, I'm giving this company an 11 times multiple, which I think for a solid business with reasonably strong growth on the top line. Second largest health insurance company in the US, I don't think that this is too optimistic, and if this scenario comes true, you're looking at a 19% annualized return on this stock. That's a total return of a little over 130% over 5 years. That's pretty good. It's not quite as good, of course, as the 25-ish% I think we were being offered when the stock was $280-ish a share, but still, this is an excellent potential reward. As far as where I see the risk, where I think the ugly bear case is, if we have revenue growth just growing 4% a year, that's only a little over inflation. I think, by the way, this is very unlikely. Revenue growth is going to be strong. The question is margins. In this case, I kept margins at 4.5%. I am assuming no margin recovery at all for this stock. Yes, we get a little bit of money coming back to us shareholders, less than I have in my base case, and I'm only giving them an 8 times multiple. I think this is extremely pessimistic, arguably too pessimistic. Maybe 9 times, we'll put that in there. But if these assumptions in this scenario come true, you're not even down on your money. You're basically flat on your money over 5 years. Yes, this would be a disappointing result, but I think the risk is low with Elevance, even after the price increase. And if they have a full turnaround here, if revenue keeps growing, 10-ish% on the top line, operating margins make it back to 6.5%, and I give this company a 13 times multiple, then you're looking at close to a 30% annualized return on this stock. That's between a 3 to 4x over 5 years. Personally, I think this bull case is more likely than the bear case I put in, but regardless, I think risk reward is good. I continue to like the stock. Now, just checking what the market reaction has been to this report. Pre-market, I think the stock was up about 3%. Then when the market opened, it was down about 4%. It came back to roughly break even, it seems here, by the time that we started recording this. Now down 1 to 2%. So I guess this earnings wasn't quite as good as the market hoped. Regardless, I don't think my opinion has really fundamentally changed on the company from this earnings report. As far as what I'm going to do with my position here, I'm certainly not selling. Between Elevance, UNH, and Centene, I have a reasonably sized position in healthcare, so I'm probably not looking to add, but definitely not looking to give up my shares at $350. So I will be holding. This isn't advice or a recommendation for you to buy or sell any of these stocks, just telling you what I'm doing with my money. And as always, if you got value out of this video, subscribe to the channel. We're definitely going to be checking out UNH's earnings when they release that a week from today. If you agree or disagree with anything I said here, leave that down in a comment below. Thank you so much to everyone who supports me on Patreon, and I hope to see you all in another video.